Recessions aren't fun to live through, but the good news is that if you're prepared, they don't have to be painful for your portfolio. So, what's the best move for investors? Well, joining me to discuss is Matt Krantz. He's IBD's personal finance and management editor. So, Matt, we keep hearing the dreaded R word being thrown around, and there's some debate about whether we're already in a recession, how bad it's going to get. But how seriously should investors be thinking about a recession right now?
Yeah, a couple of things to keep in mind about recession. First of all, what it is that it's two periods of a GDP decline. So anytime you have the economy declining, you start to feel kind of pain in certain ways, and we'll talk about that in a bit. There's been a couple of things you should know about recessions. There's been 13 of them since World War II. That's according to Sam Stovall at CFRA. And this S&P 500, here's a surprise, actually rose 1% during recession since 1945, which is really surprising for people. However, since 1990, the S&P 500 has fallen about 9% during recessions, which is more in line with what people think. The longest recession was 22 months, and on average, they're about 10 months, so they're less than a year. So it's not like this terrible period that plagues you for decades.
Can you tell us a little bit more about the research you did about these recession-beating stocks and why you're focused on the S&P 500?
Yeah, so the S&P 500 is kind of where everyone's money's at. It's the benchmark for the market. So it's really a great indicator of how things happen or what happens during recessions. And on the good side, they do what you kind of expect. So if you were to ask most people, what do you think would do the best during recession? They'd probably say very safe stocks. As a result, the number one sector during recessions is healthcare. It's up about 1.8% on average during recessions, which is totally understandable because you're still going to go to the doctor even during a recession. The second best group was consumer staples. They're up 0.4%. And that's not surprising either, since these are things you have to buy. So food, beverage, and I think cigarettes are included in that as well. So these are necessities. So that part of a recession is follows the playbook that you would expect.
And you hit on some of the best sectors in the recession, but what are some of the worst places to park your money when a recession hits?
Yeah, so great question. Where you don't want to be during a recession is real estate. It's a disaster. It's down 31% on average going back to World War II. It's just kind of the nucleus of where you don't want to be. Makes sense. Rents soften, demand for real estate softens, people can't afford property, just kind of totally makes sense. The next worst place to be are financials. They fall about 17.1% on average during recessions. Again, pretty typical. It's not surprising, but there is a surprise. What really surprised me was another really bad place to be during a recession are utilities. They're down 16.5% on average during recession. That really surprised me because you think you're not going to turn off the power either. But that's the way the numbers kind of fall out.
It's really interesting because that also seems like an elastic necessity. In terms of individual stocks, are there maybe certain plays that hold up better than others?
Yeah, we actually did sit down and take a look at that. And that's the true irony of all this, is that even though there's a recession, it doesn't mean you're going to lose money. In fact, there's a kind of a cloud security company called F5. That stock jumped 78% on average during the last three recessions, which is amazing. Another one that did really, really well, and this one's more understandable, is AutoZone. So during a recession, as you can imagine, people keep their cars longer and they use duct tape to hold them together and they do whatever they can do. As a result, people go to AutoZone and they buy materials to keep their old jobbies running. That's your second best stock in the S&P 500, getting on average 64%. So it's also important to note that sometimes recessions are a little bit surprising. For example, a lot of people are expecting a recession next year, but the analysts are pounding the table for next year for revenue growth at casinos and cruise lines. These would be very unusual, but their numbers were so depressed that maybe they were down so much that the growth is easier to come by, even if next year is a recession.
Right. I feel like there was so much pent up demand, and I think people want to get out and live their life right now. But if I'm an investor who wants to focus on growth or tech names, are there opportunities for those types of stocks to outperform in uncertain economic times, or should investors really be focused on these defensive areas and value stocks and maybe wait for a better economy before thinking about growth again?
I'm really glad you asked this question because it's at the core of this whole issue. So here's a real stunner. During recessions, growth stocks actually do better than value. Growth stocks fall by about 5% on average during recessions, and value falls by about 13%, which is really a head scratcher. But the reason is, and we'll talk about this in a minute, is because recessions are like turf races at the horse race. You don't know what's going to happen. It's already priced in. By the time you realize that you're in a recession, it's too late. So these are totally anticipated. So by the time the recession actually begins, that's not the time to be buying value stocks. That's the time to be buying growth stocks. And that's the true kind of counterintuitive thing about investing in recessions.
So what is your key takeaway for investors here?
The key takeaway is very difficult to explain, but this is what it is. Basically, by the time you feel like you want to make a decision or a change based on us being in a recession, it's probably too late because recessions are so anticipated by investors. The big moves happen 6 months, 3 months prior to the recession. So if you start buying value stocks when you think the recession started, you probably should actually be buying growth stocks. So I think that's the big takeaway is trying to time recessions is really, it's interesting to learn about them and they're very important and they're part of our economic cycle, but trying to time them with precision is really tricky.
Well, Matt, thank you so much for your time and helpful information today.
All right, thanks for having me.
And you can head on over to investors.com for more coverage for Investors Business Daily. I'm Alexis Garcia.